before we get started, I want to introduce one of our sponsors. We have two sponsors, and they're in the book, but I want to, I think the last few conferences, we've kind of been down this road a little bit of sort of my personal lamenting about how difficult it's become for small companies to raise money, and it's just getting harder, it seems like. And, my attitude about that is that I think that companies are going to have to sort of invent some new ways and come up with some things and be creative. And it's part of the reason why I've asked these two sponsors to come, because I'm not giving either one of them enough time to really explain how they can do that. So maybe I thought if they could come up and just sort of introduce them, that maybe they would be able to tell you enough to pique your interest and maybe come back and you could have a conversation with them, when we move to the suites this afternoon. But I think they're both doing some things that are really, really creative. And I think maybe some things that small companies trying to raise money can take advantage of. So, I'd encourage you to sort of listen to the very brief time that I've given them, but then maybe spend some time with them afterwards. And so the first of these companies is a company called Clearing Bid. And Matt, why don't you come up just for a few minutes? I don't know how long I've known Matt. I mean, Matt came to my conferences, I don't know how long ago.
30 years.
Yeah, 30 years ago. Wow. So
You're old.
I know I am old, but Matt's one of those guys that's been around the industry forever. Really, really brilliant guy. And I think what he's doing, the best way I can describe this is that he's really trying to democratize the IPO market. And I'm not sure that he can do this in 5 minutes, so you may have to have a comment. But I think what he's doing is brilliant. And I think if he can pull it all together, that it could be something that could be really, really disruptive. And I have to be careful what I say, but I do want you to know that Matt's raising some money. If you want to have a conversation with him, you can talk to him about that specifically. I don't want to get in the middle of, breaking any rules. So,
solicitation.
Yeah. So with that, I'm just going to give Matt a few minutes and let him try to do this. This will be interesting, but like I said, if you have questions, he'll be around and you can talk to him later as well.
Thanks, Dave. It's a pleasure to be here. Thanks so much for the opportunity to join everybody. I'm here with my colleague, Chris Whitcomb, over there. Chris joined us about a year ago, also a veteran of Wall Street, and lives out in Florida. So he came from Florida, he came from California. So we're converging in beautiful Denver today. So, well, the IPO process really does need democratization. Today, it reaches only a fraction of investors. There's no price discovery, and there's really no transparency or innovation. And so we are part of the democratization process. And really, at the end of the day, the capital markets is one that has progressed significantly, but IPOs and underwriting just hasn't. And really, when you look back over more than 100 years, everything's still the same. Companies that want to go to the market really have limited options in terms of who they can have their deals underwritten with, and which investors, at the end of the day, have the privilege of investing in their companies. So what we're really doing at the end of the day is we're connecting everybody through really, if you will, the same principles as secondary market limit orders. But you have to have a financial advisor that does KYC, suitability testing, know the customer. But every one of those firms has the ability to place an order on behalf of their customer. The customer can be a previous investor, it could be anybody in this ecosystem that wants to be able to purchase shares in an IPO. There's no discrimination. So what we do is we feature a company on our website. It's an event page. The event page has all the relevant marketing and offering information, and we can show you a demo later, and all the pricing and information on demand. So we actually, practically speaking, have a price volume graph as that order book is building. And what happens is, as orders are placed through financial advisors on behalf of any investor, institutional or retail, those orders then are directed to the lead manager through the existing order management system of each firm, just like today in the secondary market, just like sending an order to the New York Stock Exchange with a limit order. And those orders populate the master order book, and then they get displayed publicly on our website for everybody to see with all the requisite marketing information. So literally, at the end of the day, you're placing an order. If your order's in the money, you're entitled to a fill. You're guaranteed a fill. meaning you're getting allocation if your price is at or higher than what that ultimate IPO price is. And we can spend some time later talking about how the algorithm works, but at the end of the day, you find the clearing price, and at the end of the day, the clearing price is where you can sell 100% of the offering, but the underwriter and the issuer have the ability to discount that a little bit when there's more demand than supply, and then the allocations are based upon the timestamps of the order. So again, following secondary market principles, price and time, just like a secondary market order. Now, an issuer picks their underwriter, Goldman Sachs, Stifel, doesn't matter. Do the same thing they do today. They go to the market, they market the offering. But the significant difference is that every single selling group in that underwriting has the ability to place an order. Today, they show up on page 85 of the prospectus. They don't have the ability to put the order in. Every order goes to the lead manager, their syndicate desk. They make the decision where to price it, who to allocate to. In this case, everybody can participate because every one of those selling group members is incentivized. They earn a commission, or they're adding assets under management, or both. And then we also have a relationship with Virtue. They have connectivity to over 700 firms to provide that continuity and ubiquity there. And then again, we're able to allow this expansion to this broader universe of investor participation that today just doesn't exist. So a nice quote here from our pal Steve Cavalli at Virtue, but literally, we're going to open up the market to everybody. And this is the way it should be. The secondary market doesn't discriminate. There's no reason why the primary market should. And it's a fallacy that they have that ability to. So I want to be sensitive to the time here. We spend a minute or two if you want, Dave, on questions, but you tell me what you want to do. I got you all in.
How does it differentiate from like what they call crowdsourcing? Is it because crowdsourcing is not an official IPO event, or what's the differentiation?
Yeah, so the Reg CF crowdfunding is much more lenient in terms of the ability to put an offering up on a platform. Like we did a $5 million crowdfunding a year and a half ago through WeFund. Sold out in 2.5 weeks, 3,900 investors, which was great. But it's a much less rigorous process. You only need a GAAP audit versus a PCAOB audit for an S1 prospectus. But we're fully registered with the SEC. It's an IPO with an S1, and it's got a lead underwriter. They go out and market and do exactly what they do today. The crowdfunding is really a way to, solicit orders over a platform, and it's, come one, come all. And the problem is deals are sold, they're not bought. So you really do want a soliciting party, like a participating syndicate member of the underwriting group or the lead manager, to go out and solicit those orders from institutional or retail investors.
So is this, is it fair to say this is an add-on to, if there's a bank leading, going out marketing to traditional institutions, there's an add-on syndicate service? Because a lot of times banks will engage syndicate to go out to get small orders, family offices, individuals.
Yeah, the fatal flaw in the past is efforts to go out and take a cornerstone of an offering and try to manage that. The underwriters don't want to see it. One, they don't like to give up the economics. Two, they claim that those shares are going to be flipped back. So in our case, every single order is tagged. Every single order has a customer order ID. And at the end of the day, every single order that's in the money gets filled. But each order is going through each syndicate member who can place an order over the existing order management system. So we see the whole order book. And the algorithm is really predicated upon the ability to see the whole order book and figure out where they want to price it.
Great.
So can you just explain, because I actually think one of the really interesting parts of what you're doing, I don't know if you couldn't really get, it's hard to show everything you're doing here, but at the end of the day, what happens is that from the issuer's perspective, they see that order book, and they really got to have the ability to decide where they want to price it based on kind of where the demand is in that order book, right?
In our case?
Yes.
Yeah, well, yeah, what they'll see, Dave, is they're going to see, we can sell 100% of an offering, 5 million shares at 25. And that's where supply meets demand. But you wouldn't want to price it at 25 because there's no aftermarket pop. You want a little bit of a 10 or 15% pop. So they're going to say with the underwriter, we want to discount this a little bit so there's more demand than supply. So in the secondary market, those bids are there stabilizing that secondary market, bidding up a little bit, not doubling or tripling.
Okay, so, but as opposed to, not that the investment bankers out there would be, nefarious or, whatever they do. But the way that process works today is, the banker comes back and says, well, I know we were going to raise you $20 million at $20, but now we only think we can raise you $10 million at $10. And then you're sort of left going, well, that's not really the same calculus we were counting on. But in your case, they at least get to see that order book and they can actually see where that demand is and where that pricing is, as opposed to just taking someone's word for it that, well, I can't do 20 million and 20, but I can do 10 million and 10. You don't have any idea whether or not they can actually do it in between them. There, you do, right?
Yeah, today, I mean, it's very opaque and it's done behind closed doors and it's predicated upon the large investors and what they're willing to pay. And generally, the underwriter is going to underprice and underallocate so they don't have any market risk. But in to your point here, the book is open, so everyone sees what the demand looks like. And we're casting a wide net, so you have literally millions of investors, because at the end of the day, the real determinant should be the market in terms of valuation. Okay, thank you, Dave. Thanks for the opportunity. We'll be around. Chris and I, as a follow-up, anybody would like to chat about it. So great to be here with you, Dave.
Thanks, Matt.
Thank you so much.